Hi, I'm Scott Olson, co-founder of LTCshop.com and author of Long-Term Care Insurance Now. This year, 2026, we're sharing 26 client profiles. These are not hypothetical examples. These are real people, real policies, real premiums, real health histories. I'll explain why I recommended one policy over another and how each decision was made. A question I hear all the time is, what if I apply for long-term care insurance but get declined? Well, in this episode, we're going to talk about clients of mine who in the past year have applied for long-term care insurance and been declined. And I'll explain how we handled each situation. Next, we'll talk about Peter. Now, Peter's a 63-year-old male who's been in a committed relationship for a long time, and it's very, very important to Peter to protect his assets for his significant other. He does not want his assets to be drained from the costs of long-term care. However, he lives in a high cost of living area. And high cost of living areas are usually also very high cost of care areas. So we applied for a policy with one of the top long-term care insurance companies. He had some health issues, but they were all well controlled. For example, he had anemia, but it was being treated with supplements and his iron levels were fine. He had an enlarged prostate, which was controlled with medication. That's something usually not of concern to long-term care insurance underwriters. High PSA levels can be a big concern to long-term care insurance underwriters, but his PSA was fine. So we assumed he would be approved super fast, but he was declined. Turns out he had a condition with his bladder that most companies considered to be uninsurable, but the condition had been surgically repaired 5 years earlier. Now, I knew this had to be a mistake by the underwriter, so I asked Peter to get a letter from his doctor explaining that the surgery resolved the issue and that it was not a chronic condition. We sent that letter directly to the underwriter, and they reversed the declination. He was approved with the standard rates, which is what we had expected from the beginning. He applied for a policy with a starting monthly benefit of $7,000. Again, he lives in a high cost of living area. Home care and facility care are very expensive in his area, so he wanted to buy higher benefits than an average policy. His policy would start off with $330,000 of policy limit. He was very concerned about inflation also, so he purchased a 4% compound inflation protection rider for the policy. That means his policy is guaranteed to grow every year by 4% compounding. That means his benefits will double every 18 years. So by age 81, he'll have a monthly benefit of $14,000 and a policy limit of $660,000. By the time he reaches his late 90s, if he hasn't needed care by then, his monthly benefit will be $28,000 and his policy limit will be over $1.3 million. This way, he may be able to avoid spending down his retirement accounts because he wants to protect them for his loved one. His annual premium for those benefits is less than $6,100 per year. The lesson here is that sometimes underwriters make mistakes. They are human, and they have a lot of files and a lot of medical records to review. For me, part of my job is to make sure that the underwriters get the information they need in order to make the right decision for you. Thanks.